Well, let's back up a little bit, Tom, and good morning to you, Paul, as well. What we have, of course, is an American economy that was never gone. The American economy has been dominant truly since the end of the Second World War. We have been very fortunate. We have been blessed, if you will, by decades of investment in education and science and other forms of research. And so we have a stock market that is reflecting that. When I take a look at recent stock market performance, I see that investors are focused on basically corporate profits at this point, and companies have not been disappointing. Here's the question, I think, for investors, and that is, with valuations at current levels, is there any room to hide if there are disappointments? And that to me is an issue, not just for traders, but also for long-term investors.
So, Abby, how do you think what's the valuation discussion we should be having about this market? Because a lot of folks are citing high valuations, but it seems like the earnings are out there to support them. How do you think about it?
The earnings clearly appear to be out there, which is great. I'm very pleased about that. I don't see a recession coming in the US this year. Also, great news. And what we need to recognize, of course, and so many people who have been on Bloomberg in recent weeks have talked about this, is the ongoing rotation that we're seeing in the US stock market that is reflecting this challenging valuation environment in some sectors. And I think that's a healthy discussion to have. We do see that some sectors that have been laggards have been moving ahead. And we also see that some markets outside the United States have also been performing better. One of the big question marks out there, of course, is the dollar. Right now, we have investors who are basically saying they're focusing on corporate profits, they're focusing on cash flow. The intermediate and long-term picture, however, to me looks somewhat cloudier, particularly with this valuation overhang in some sectors.
Paul Sweeney, Abby Joseph Cohen's iconic financial analyst journals paper was on Aristotle. She studied with Aristotle in her intern program at Goldman Sachs years ago. And I look, Abby, and I want you to talk to people about the historical moment we're in. I'm not going to bore you. You know where we are. Gold, 5,300. We've got dollar. I got a president tell me I want weak dollar policy. Let's be kind. It's a neo-mercantilist policy. Do you perceive the presidency of Donald Trump is a one-off for financial markets? Or is there a new reality here we have to adapt to?
Well, I'd like to correct you, if I may. I didn't study with Aristotle. It was Sophocles.
Okay, that's good. Don't drink the beverage.
But there you have it. I'll stay away from that as well. We have a situation right now where I think that investors and especially traders are really focused on the very short term. What's the profit picture? Is the Fed going to adjust short-term interest rates and so on? And we have, nevertheless, a broader policy mix, which is not necessarily all that favorable on a long-term basis. So, for example, the trade policies which have been implemented, all other things being equal, notice I use the ceteris paribus in there, but all other things being equal, the trade policy we have pushes inflation higher, not lower. The fiscal policy we have right now will stimulate economic growth in 2026 through the depreciation allowances, through the extra checks that middle income families will be receiving. But all other things being equal, that too pushes up inflation, as does the weaker dollar. And so when we have the president saying, as he did, he's okay with a weaker dollar, which is a rather unusual thing for the president of the United States to be saying, that basically tells us something about the intermediate to longer term view. Because keep in mind, the Fed, whatever it decides to do today, the Fed controls only the Fed funds rate, only the very short-term rate, only the rate that banks borrow at. The rate of borrowing for everyone else in the economy is done further out along the yield curve. And that could be problematic. because all of these other pressures suggest that those interest rates have moved higher. Now, what's also fascinating to me is that the administration is talking about a number of steps that others would view as economic or market interference. For example, telling banks what credit card rates they should be charging.
Oh, here we go. She's touching the third rail. Are you teaching that?
And also the discussion in terms of controls on the mortgage markets. This is something that we've not seen in a very long time.